Hello, everybody. Welcome yet to another stream. All right. Today I just want to ask you a simple question, right? Because it is important to understand the context of these things. Should the stock market crash 30% next year, most people will naturally panic. But you know what? The 1% will quietly just buy more. And the single difference between this is not intelligence, it's not luck, it's what creates generational wealth, which is something most people really aspire to. This is what makes the difference between people who build wealth for generations to come and people who don't understand how that happens. Now, let me tell you something. It's not about intelligence, it's not about luck. This is about careful, thoughtful, intentionally strategic thinking. Now, let me say something uncomfortable. If you are an immigrant, you sure are working very hard. You're saving your money. You're doing everything right, yet you still feel behind. You still feel inadequate. You feel like your process of building serious wealth and assets is still lagging behind. What that tells me, therefore, is not only about the resources that come in, it's not just about the money, it is also about the plan and the strategy towards that. You know what? Most of us came from nations as immigrants into those countries, out of countries where we were taught very wrong about money and wealth building. And I don't blame our parents for that. They only could lead us and show us with what they knew. And until they knew we know better, then we can do better. Because most of our parents mastered survival, but they never really mastered ownership. They never really mastered ownership, sorry. They never really mastered the ability and the importance of accumulating assets and holding on to those assets for a long time. And 20 years from now, think about it very carefully. If you don't do something different, you don't rewire your mind, transform your actions, have a plan, a strategy, and an easy, repeatable system, your children will naturally inherit one of two things. They will inherit assets or they will inherit financial anxiety. Now it's for you to decide that. Nobody can make that decision for you because you are the owner of that decision. You are the captain of your ship. And if you don't make that decision, the outcome for your children can easily be predictable. You would have realized by now, if you've been working for a few years, that the difference really is not how hard you work. It will be whether, as you work hard on yourself, on your job, you also work hard on yourself. It is Jim Rohn who said that if you work hard on your job, you make a living. But if you work hard on yourself, you make a fortune. So it is not only about working hard on that job, but it's also about building a system that consistently, progressively gives you ownership to assets. So today I'm going to show you the only 5 ETFs I would hold for the next 20 years. Even through crashes, even through market downturns, even through recessions, those are the ETFs to hold for the next 20 years. The one rule you must always remember in this whole process of investing, the one rule that turns market into wealth acceleration is the ability to hold the right assets for a period of time. Because over here, we don't react to markets. We don't just act because the market is changing. In my community, the people I talk to, the people who listen to me, they know that when it comes to investing, you don't take knee-jerk actions. You don't act by how you feel. You don't make quick decisions. Your decisions have to be thoughtful, methodical, strategic, comes from a place of clear data and not feeling. Because in this community, we architect wealth. We architect a plan that would live with you and outlive you. So as we're going to be talking about the 5 ETFs that you should hold for the next 20 years. I want to remind you again that I'm certainly not a certified financial advisor. So anything I tell you here, I'm not your financial advisor. This is just information and educational purposes. You have to do your own research. And if it makes sense to you, then you go ahead and invest in those assets. I am just telling you the things that have worked for me and for the many people who followed my plan. But here is what you also need to understand in this process. There is one strategic wealth transfer miss that most immigrants miss. And this is not really about ETFs. This is not about stocks. This is not about bonds or savings account, right? This is truly whether your children are going to inherit assets or anxiety. Full stop. That is really it. I hear a lot of African parents always talk about the fact that, I want to make sure I leave for my children what I didn't get when I was growing up. But there is never really truly a strategic and organized, a concentrated, and a long-term plan to accumulate things that will stay behind. Yes, we can leave them education. Yes, we can leave them exposure. That is powerful too. But you know what? The statistics indicate that the children who come into a certain amount of assets, it gives them a leg up in life. So when you're thinking about this, understand the power of why accumulating assets will make a difference. And today we're going to be talking about the one very critical asset class called ETFs. And ETFs, of course, as you might know, if you don't know yet, ETFs is a bucket of stocks. So it's a bucket of companies. So instead of buying Amazon as an individual company, Apple as an individual company, what an ETF seeks to do is it puts together all these companies into a bucket, and then you buy a slice of that bucket, so that you are buying a slice of hundreds, thousands of companies sometimes in a single share of that ETF when you buy. What that does is it mitigates your risk, right? So you need to understand that generally, of course, the market grows by about 10% a year. We know that. If you've been listening to me, you've heard that multiple times. And knowing comes from hearing. And when you hear, and it becomes second nature. So $100,000 at 10% will compound over 20 years to $672,000. At 12%, it will compound to $964,000. So think about it. What if it's $1,000 a month invested over 20 years at 10%? That's $765,000. Crashes are normal, I want to remind you. Recoveries are historical facts. There is no question about that. So the crashes will come. 28% of the time they will come. 78% of the time, 22% of the time they will come. 78% of the time the market is going up. But the key is, if you don't know the things to buy consistently, you don't know the kind of assets to invest in, whether the market is going up, it doesn't help you, because you will be invested in assets that don't necessarily appreciate, or assets that during downturns of the market will crash to a point where it cannot recover anymore. That's why I want you to stay till the end of this video. Pick up your pen and your paper. Note the things I'll be talking about, because you can take this training tonight. You can take the information I give you from this live stream and you go start implementing immediately, and you're going to start seeing results immediately. You need to understand that our parents mastered survival. We have to master ownership. Yes, it's important also to understand to master survival, because sometimes in life you need your survival skills. But we have to go one step further than that. We have to master ownership. We have to master ownership. I know most parents growing up in Cameroon and many parts of Africa, I believe, for most immigrants coming from countries which are not necessarily economically advanced, most parents will invest in things like animals. Buy a goat or two, make sure that it procreates so that it delivers more goats and they could sell when kids have to go to school. Or maybe they are rearing a few chickens in the compound so they could sell when kids are going to school. All those things were their own limited strategies to try to build assets. The ones who could really do it better, the ones who had a little bit more resources, would build houses, which they could maybe put on rent and eventually hand it over to their children. Some acquired land, which they could hand it over to their children. But most of that was a small number. Most of the parents didn't know what to do. The ones who even knew something to do, a lot of times they didn't even have the resources to do that. So if you're sitting here, you have the means, you have a job that pays you consistently, you have a means of income, you've set aside your emergency fund, which I usually recommend is 3 to 6 months of living expenses. You put that in a high yield savings account. Don't put it in the stock market, put it in a high yield savings account. That way you can always have access to that money anytime you need it, right? And not only that, but there's no volatility affecting that money like it affects the market once in a while. Once you have that covered, then you go ahead now and you certainly start investing in your own future. And when you start investing in your own future, then now you are migrating from not only non-mastering survival, but you're starting now to master the art of ownership. If you operate in America, you have to understand America is a capitalist system. And the number one goal and strength of capitalism is ownership. Capitalism is a system that rewards creativity, innovation, and ownership like no other system. That is why the government of America gives a lot of tax breaks to people who own businesses, because the government is trying to incentivize you to become an owner. I need you to understand that, guys. You have to strategically understand why I spend time talking a lot about these things. Because these things are no fluke. These things are what is going to completely transform your life. These things are what is going to make you be able to have a job as an option, not as a necessity. It will give you a chance to be able to see clearly, not from a place of pressure, not from a place of obligation, but from a place of choice where you decide to contribute to humanity in ways that you want to contribute. We all have dreams in our hearts, right? And when you invest in assets, those assets over time start generating the income and the revenue that you need now to start contributing some of the things you love, which might not necessarily be income generating, but will give you satisfaction, will give you comfort in your heart, and will give you a sense of great belonging. So let's go down here. Here is what really separates the 1% from the middle class. The average middle class income in America today is $65,000, I think. That's the average, the median income, right? If you are in the middle class, which most people are, right, you are already feeling the squeeze. Inflation is hitting you from the left, right? Rising prices in houses is hitting you from the right. Job security is hitting you from the middle. Nobody wants to guarantee long-term job opportunities for people anymore. Layoffs are coming. AI is coming to disrupt the market. So there's a lot of anxiety in the middle class and even in the high-earning class. There is just a lot of anxiety in this time. But how do the 1% make it? Because they say if you wanna be like them, you have to learn like them, you have to study how they act, and you have to replicate what they do. Right? So you have to understand. If you take, for example, you miss the 10 best days over long periods, right? That certainly can affect your returns. But trust me, if you just hold over a longer period, you will still be way on top. When markets fall 20%, that's a 20% discount for owners. But for people who don't understand, to them, it's a 20% loss. And you must always remember you only lose on the stock market when you sell your asset. If you don't sell your asset, you don't lose. Until you sell your asset, it is not a loss. So, for example, if you've invested $1,000 in Tesla stocks, for example, and Tesla drops to $500, it's just a temporary loss. It's called a paper loss. You haven't lost anything yet. Because in the next few months, in the next few years, Tesla could rise again, and that $1,000 investment could be $10,000 investment. So you only lose when you sell. That is why it is important to focus on investing for the long term. So that way you have enough time for all this gyration of the market to be accommodated. Think about the shock absorbers of a car, right? What does it do? Especially those who drive in rough terrain or off-road, or maybe in countries where the roads are not very good. If the car has a good shock absorber, what happens? When you get into a pothole, you don't feel the impact on your body. If the car doesn't have a good shock absorber, when you get into the pothole, it hits you, you get thrown out, and it hits your head, you hit your head on the ceiling, and you land on the seat again. That is the difference. The market is about like that. If you invest in an asset that doesn't have good shock absorbers, when the market drops, that asset can even break down. Like some of the cars that break down when they get into potholes at a fast speed. But if the asset has good shock absorbers, which means it's a good company, it was a good ETF, then it will bounce back and keep rising. So that is how the 1% think. When they see a 20% drop in the market, to them it's a discount. To them, they're getting Microsoft at a discount. I can't tell you the number of companies over the last 1 month that the market has been red that I have increased my position on. And this is, of course, no recommendation for any company or any ETF, but I'm just telling you, ETF like VOO, companies like Microsoft, companies like AMD, I've increased my position in those companies. Costco, Walmart, United Health, right? Novo Nordisk. These are companies that I believe have shock absorbers. So no matter what the market does, 10 years from today, these companies are going to be worth 10, 15 times more. So I am just putting my bets on them. But that's a small part of my portfolio. A big part of my portfolio is ETFs. And those are the assets I'm going to be talking to you today. I'm going to be talking to you about the 5 ETFs that you can own for the next 20 years, and you would know for sure that it's going to end well. And at every point in time, even during the times of red market, even during the times when recession comes, I want you to do one thing. And this is the one thing that the 1% do all the time. You know what they do? It is called BBB. And that doesn't stand for Better Business Bureau, guys. It stands for buy, baby, buy. That's my strategy. Buy, baby, buy. Right? That is what happens even in those times. So let's get going here. Before I even get to that first ETF, I want to take us down a little bit, slow it down a little bit, and just leave something upon your spirit. You see, I believe very strongly that the art of building wealth and building a legacy must first of all start in your spirit. It must start in your mind, it must start in your belief system, and it must also start in the power of believing in something that is beyond you. I want to leave you an ancient wisdom here that comes from the Bible, right? And of course, as you know, if you're a Christian like me, you know for a fact Christianity is the practice of a faith that we continuously seek the face and help and strength, courage, and clarity from God Almighty. You are never good enough. You are never perfect enough. You are never holy enough. It's a constant journey towards clarifying our purpose and seeking his face and asking the Almighty to bless us. So listen to this. I want you to listen to Ecclesiastes 11:2, and it says, invest in 7 ventures. Yes, in 8. You do not know what disaster may come upon the land. Invest in 7 ventures. Yes, in 8. You do not know what disaster might come upon the land. Now, understand this, guys. This isn't a new idea. When I'll be talking to you right now about ETFs, the ability to bring multiple companies together and sell them in pieces, it's not a new idea. You might think it's a new thing because they coined it an ETF. They started selling ETFs, I don't know, maybe 30, 40 years ago. You think it is new? It is not new. This whole idea of mutual funds, ETFs, index funds, it has existed even in the biblical times, because the Holy Book tells us in this Ecclesiastes chapter, right, that you have to invest in multiple ventures, 7, even 8, so that when disaster may come upon the land, you will not lose completely. So if you invest in an ETF which has 100, 200 companies, even if 10 of those companies are going through a bad season, 90 of them are surviving, right? All of them cannot be going through a downturn at the same time. That is what it means. So when you think about a lot of this economic context, there is a lot of inspiration that comes from that book. It talks about diversification, which is one of the key elements of ETFs. It talks about, preparation for disaster. ETFs are the assets that really gives you the opportunity to mitigate risk and stabilize your portfolio in a way that your portfolio doesn't go up and down very frequently, no matter what the market does, right? It talks about spreading your risk, not putting all your assets in a few individual companies. You are putting your assets in multiple companies, so that way you are really even betting on the belief and the growth of multiple companies at the same time. That principle existed thousands of years even before ETFs were created. So what we are doing today is not new. What I'll be teaching you about the 5 ETFs you have to hold for 20 years is not speculation. It is structured wisdom. This is things that are clear and have been proven time and time again, even with generations before us, right? So the first ETF I want to talk to you about, and if you're just joining us, please, I would like you to drop your name and where you are joining us from. I like to know where people are tuning in from, right? And if you have any specific questions, don't hesitate. Drop those questions in the comment section. I will see them and I'll respond to them. All right. It doesn't matter whether you're on YouTube, you're on Facebook, you're on Instagram, just drop the question. I will see the question and I'll be able to respond to that. All right. If you just drop your questions, I'll be able to respond to that. Any comments, anything you want to say, please drop it down in the comment section. All right. And I'll be able to respond to that. So let's get down to the first ETF I would like to talk about today. And this one actually is a foundational ETF because it is an ETF that gives you a solid foundation on which to start building. And this is the Total World Exposure ETF. It is called VT by Vanguard. VT, Total World Exposure. Now, this is really this foundational ETF because it's a systemic ownership plan, right? You want to build a foundation which covers companies across the globe. So yes, you might be living in America, you might be living in, in Canada maybe, or but you have to understand that the economy of the world is not only America. Yes, America has the largest economy. America has the largest stock market. America has the stock market that has produced the most growth and profits over the last 150 years, maybe, right? Most people around the world who invest, 9 out of 10 of them invest in the US stock market if they have access to it. There is no doubt. But we cannot also minimize other companies and other countries and other economies that have companies that are doing well. And so you want to make sure at every point in time to build that foundation for your ETFs, you want to invest in an ETF that covers the global market, the global economy, right? And this ETF actually averages about 13% annually, which means, therefore, if you do $500 a month since 2016, let's just take the last 10 years, right? If you started investing $500 a month in 2016, you would have invested a total of $60,000 by now, which is 2026. Let's assume you started in February of 2016. By now, you would have invested $60,000 in VT at $500 a month. You know what? Your portfolio right now, based on the average growth of this ETF, would be 120,000. So you've basically doubled your money, right? I mean, I need you to understand this, but you've not only doubled your money, but you've doubled it in a safe way because this is the global economy. So generally, even when America might be facing a recession, other countries might not. Anybody who've been listening to the news and following economic information and investing information like I share here, you know that over the last year, 2025, a lot of international ETFs perform better than the US stock market ETFs. So ETFs that cover the US stock market. Some international ETFs like Vexus, VXUS, right? VT, they performed a lot better last year, which means companies out of America held their own. So you want to certainly invest in a broad-based global economic economic tracking ETF like VT. And the expense ratio for VT is 0.07. That means for every $10,000 you invest, $7 per year is the cost of managing that ETF. You have to understand there are people to manage it, right? So key characteristics of this ETF I want you to understand. Number one, it comprises of 9,000 plus global companies. So there are over 9,000 companies in this ETF. So this ETF is a piece of over 9,000 companies in the world. So when you buy it, you are buying a piece of 9,000 plus companies in the world. The other thing, it also covers companies in developed and emerging markets. So you have countries like America, of course, China, India. You also have emerging markets like South Africa. You have Brazil. You have Singapore. You have all of these different countries. So there are companies in all these different countries that are covered by this ETF. The low cost of this ETF is an advantage. 0.07 means you spend only $7 for every $10,000 invested a year to manage it. And now, if you think about it, which means if you have $100,000 invested in VT, your expense ratio is only about $70. That's a lot. If you watched my last stream last week, I can't remember the specific stream, I talked about and I demonstrated the power of expense ratios, the cost of managing assets. It makes a difference. If your cost of managing your index fund or your mutual fund or your ETF is 1%, over a 30-year period, that could cost you about 250,000 in fees. That's a lot of money. You have to understand these things. There's the reason why I break it down to these minute details. So that way you have information by which you can leverage if you choose to. Again, this is not financial advice, right? But these are things that work. You can take it, use it as you like. It's certainly going to benefit you. But here's the deal. This has the broadest diversification available. So if you're one of those who is saying, okay, you know what, I don't want to take a chance just on the US market, or I don't want to take a chance on an S&P 500 ETF that covers only the 500 stocks or 500 companies of the S&P 500 in America, right? You want to just make sure you hedge your bets and you make sure you invest in everything globally. This is the ETF you want to invest in, VT, right? Let's move on to the second one. The second ETF you want to consider in these 5 ETFs to hold for the next 20 years is an ETF that covers the total US market. Now, this is an innovation backbone because this ETF basically invests in all of the companies that are on the US stock market. Now, the average growth over the last 10 years is about 13 to 14% annually, which means if you invested $500 a month from 2016 till today, you would have invested 60,000, but their returns will be somewhere about 125,000, right? So that's a total gain of about 65,000. That's not small money. Now, when you start extrapolating, what if you had invested 1,000 a month? You now can see what the gain would have been, right? So this is just to tell you, it's not certainly written on stone, but it's just to give you a sense of what is possible. Now, the expense ratio for VTI is 0.03. It's even cheaper than VT, which means it is $3 for every $10,000 invested. That is $30 for every $100,000 invested in this ETF. And this ETF is very powerful because it covers over 3,500 companies in the US. So this is US-based companies. It covers both large companies, mid-sized companies, and small cap companies, right? Large cap companies are companies that are above 10 billion in market capital. Mid-size is between 1 billion to 10 billion, and small caps is I think under 5 billion or so, right? So the advantage with VTI is that it covers companies on these different categories. You certainly have small cap companies today that are the Amazons of 20 years from today, but they're still small today. So it doesn't only invest in the Amazons, the Teslas, it also invests in the Walmarts, it invests in the Costco's, it invests in different industries, the oil industry, Mobil, ExxonMobil, it invests in, name it, whichever companies, right? It invests in over 3,500 companies. So when you're buying VTI, you are buying a piece of the US economy in total. And in addition, it also invests in some of those small companies that tomorrow could be significantly massive. But you always need to understand that because it is an ETF, right? Because some companies will be rising while some are dropping, right? Your growth of that ETF might not be as astronomical as an individual stock. But the beautiful thing is that your risk is not also as astronomical as with an individual company. So VTI is the next ETF that you should consider buying and holding for the next 20 years because this is a structural exposure to American productivity, innovation, intellectual property, and the hunger for growth. There is no question, there is no country on earth that gives the human spirit the ability to dream and innovate like America. This is the only country where you can create multiple companies, you can fail. 2 years later, you file for bankruptcy, they will forgive you, they'll give you another chance because America is built on the ability for the human spirit to dream, execute dreams, and build companies that can employ people. So the government doesn't want to employ people. The government realizes that it doesn't have the capacity to employ everybody who wants to work. So for them to succeed to keep everybody employed, they have to incentivize private companies so that private companies can employ people. And when private companies do well, they employ people, then unemployment is low. When unemployment is low, people are generating more productivity. When they generate more productivity, companies generate more goods. Then people have more money to pay for those goods because companies pay them, right? And that improves the economy and drives the economy forward. So VTI is the second ETF. Now, if these strategies I've mentioned in the first two ETFs, and the whole ETF strategy is important to you, including the mindset and the whole concept of how to position yourself, how to build your portfolio, how to strategize towards wealth building. If these frameworks make sense for you, but you are still wondering how this fits into your income, how it fits into your family goals, that's exactly what we're going to be doing on the 26th of February in the Wealth Clarity and Legacy Blueprint webinar, which I'll be hosting. It's a virtual webinar and certainly no pressure, all right? I'm going to be dropping the link in the description of this video. And by the end of this live presentation, I'm going to give you a lot more details. But I just wanted to give you a hint so you start thinking and knowing that you have a way out. Don't feel stuck. Don't listen to this and get overwhelmed. Understand that there are different ways we can help you to get to your goal. So just stay with me here. Let's go. So the third ETF that you want to consider holding in a portfolio for sure. This is an S&P 500 ETF called VOO. So you could do either VOO or you could do SPY, which is a SPY ETF. Both of them do the same thing. They basically track the 500 largest companies in the US stock market by market capital. So the 500 largest companies form a part of this ETF. And now the way this ETF works is simple. At every point in time when you are investing in this ETF, this category of ETF, which is called an S&P 500 ETF, you know that you are investing in all the 500 largest companies in America. What that means, if any, they have a criteria by which they judge the company, and the number one criteria is market capitalization. How do you calculate market capitalization? Market capitalization is simple. You take the number of shares that company has out, owned by the public, and you multiply that by the price per share, and that gives you the market cap of that company. That is the simple consideration. So when any company, so they take the 500 companies that have the top 500 market capitalization by that simple metric. Any company that falls short, they replace you with the other company that become best. So let's say the 500 company faces a problem and their capitalization drop over a period of time. They have a period they give. If you cannot come back to that number, then they'll take you out and bring the 501 largest company and it replaces you. That's how it works. So the advantage of this ETF is, number one, you know for a fact the average 10-year growth rate has been 14 to 15%. Okay. So if you've been investing $500 over the last 10 years, 2016 till today, which is 60,000, your returns are actually 140,000. So you are sitting on about a comfortable $80,000 in returns, right? But you need to understand the expense ratio of VOO is 0.03%, which is $3 for every $10,000. So that is very low. That is just $30 for every $100,000, right? So for SPY, the expense ratio is 0.09. That is slightly higher than VOO. So SPY is $9 per 10,000. That's $90 for 100,000. And VOO, which is Vanguard, is $30 for 100,000. But here are the key things I want you to keep in mind when you're thinking about VOO. And you're thinking about ETFs that cover the S&P 500, because the S&P 500 is an index on the US stock market, right? Number one, as I said, it covers the 500 largest companies. Number two, it has that self-cleansing index. Like I just explained, if any company falls below the threshold, they replace that company. So at every time you have the 500 best companies. So that's a good thing. And they do all of that work for you. You don't have to bother about research. You don't have to know the companies in details. If you just buy the ETF, it covers all those companies, right? And number three, this S&P 500 certainly has a significant blue chip dominance. There are a group of companies in America called blue chip companies. And blue chip is just a category of companies that have high capitalization, have high growth rate, like a lot of technology companies because of innovation, Apple, Microsoft, all these technology companies. They're generally called blue chip companies. Meta, which owns Facebook, Instagram, and WhatsApp. All of these companies are called blue chip companies, right? So you have these blue chip companies as part of VO. That is also very powerful. Another very key characteristic of VOO and SPY is that they have a historical resilience history. Don't forget, these ETFs have been existing now for 25, 30 years, somewhere there. And if they've been averaging to 14 to 15% a year. So think back over the last 30 years. What are the different things that have happened to the stock market. In 2022, the market dropped by 40%. I think in 2008, the market dropped by what, 38% or something like that. So you have all these periodic massive drops of the market. But if this ETF has been able to survive over this time, averaging about 14 to 15%, that tells you something. We're just looking here about on the average for the last 10 years. The last 10 years is 2016 till today. Think about all the things that have happened between that time. We've had COVID, right? We've had a little bit too of the market the the interest rate crisis, right? When President Trump came in about a year and a half ago, we also had the tariff challenges. So when you package all of those different economic scares, they affect the market. But if this thing has been able to average 12, 14 to 15% a year, that tells you that it has a history of resilience. It has a history of hanging in there even when things go wrong. So you want to be able to invest in systems like this, because this is what gives you peace. This is what gives you calm when the market is red. This is what makes you able to smile, because you know that it's just a matter of time. It's coming back, right? Even if you trade, which is something I don't talk about on my platform, because trading is for people with a lot of expertise, and only about 2% of people ever make money in trading. But even traders have 70 to 80% of their portfolio first in ETFs and stocks of solid companies before they even attempt to make extra money trading. So you must understand that you have to be an investor first. That is the first way you build wealth in this country. Investing, ownership, equity. That is it. So you must to understand, when you are getting the S&P 500 ETF like VOO and SPY, you are actually owning elite corporate companies. You are actually putting yourself now as an owner in the elite corporate layer, because all the top companies you are thinking about in your mind, that comes to your lips like this, you are going to be an owner of those companies. Even the pride of that is something massive. Just the feeling that I own Apple, it feels good. Even though it's just a small, minute piece of Apple, but you know what? I walked into an Apple store not too long ago to check out some iPads for my daughter who needed to replace her iPad. And I was joking with the salesperson that, hey, when your owner comes in, you have to greet him with some nice respect. The guy started laughing, of course. We are just joking. I said, because I own Apple shares. And he burst out laughing. Right? But truly, I own Apple shares. And I own them through an ETF like this. And I own them too individually. So that's certainly part of a wonderful strategy, right? Let's see here. What's next? Now let's talk about the fourth ETF, which you certainly have to consider as part of your portfolio. It's not easy. You think talking like this is easy, right? No, it's not. Anyways, but I love it. This is what gets me excited, because I really believe if I'm impacting your life positively, I'm giving you ways by which you can certainly transform your life. I'm happy. It gives me a lot of joy doing that. So let's talk about the cash flow architecture layer. And in this layer, we are talking about dividend growth ETFs. We're talking about SCHD or VIG. VIG is from Vanguard, SCHD, I think that's from Schwab. That's a Schwab dividend growth ETF. And dividends are monies that are paid by companies to stockholders as a thank you gift for owning their stock. You must also understand dividends are considered revenue. So there are some qualified dividends and non-qualified dividends. And it will determine how much taxes you pay on that. But for most people, the intelligent thing to do, don't request your dividend to be paid to you every quarter. Just request that the dividend be reinvested, which means the dividend, instead of being given to you cash, it will be given to you in the form of stocks. So you'll be getting that amount of money will be reinvested back in that ETF, right? That's the way you grow it. But you can then now start leveraging it when you need income later down in your life, because you must understand the dividend ETF is income objective. The goal of the income of the dividend growth ETF is to generate income for you, passive income, through the growth of your stocks within that ETF, but most importantly by the dividend that those companies pay. Because you must understand an ETF like SCHD contains about, I don't know, 300 companies or something, right? And all of those are 300 of the top companies in America that pay dividends every quarter to their shareholders. So even though the growth of that ETF might not be as much as the other ones because it averages only about 12, it has just averaged about 10 to 12% over the last 10 years, right? So which means if you invested $500 a month since 2016, the last 10 years, you would have invested $60,000 a month, which means over the last 10 years, you would have seen a growth of about you would have grown to 110,000. So that's about a $50,000 growth. That's not bad. But in addition to that, you also have the dividends that are being paid, and those dividends are reinvested, which means you slowly be getting more and more shares of SCHD if that's what you invested in. SCHD is about, I think, $27 or something, $28. I don't know what the price is today, right? But now you can see how those things become possible, right? I invest in SCHD, so I know exactly how powerful that is because I set it up in a way that the dividends that are paid every quarter are reinvested. And these dividends come from all those different companies that are owned, that are part of this particular ETF. Now, it's also important to understand that the expense ratio for this is actually 0.06. So that's $6 for 10,000, $60 for 100,000, right? The dividend yield is approximately 3.4%. That's the dividend yield for this ETF. So what the dividend yield is actually a percentage of the total investable funds you have in this ETF that is paid to you as a percentage. So 3.4% of the total value of your SCHD, for example, your SCHD portfolio, 3.4% of that will be paid to you as a dividend every year. So think about it this way. Let's say you own $100,000 worth of SCHD. 3.4% of $100,000 is what? 3% of 100 is what? $3,000 or something? Yeah. So you'll be paid $3,000 in dividends. Yeah, I think so. 3.4%. Yeah, that's $3,000. Right? $3,400 or something like that. So you need to understand that. Now for the VIG is an alternative too. It is very good. It is just like SCHD. You can do any of them. It doesn't make a difference, right? These are some of the top dividend ETFs. For VIG, the expense ratio is $6 per $10,000, which is 0.06%, and that is $60 per $100, right? It has a yield of 3% as of today, right? So that's about $3,450 of income every year without selling your shares. That's not bad. So therefore, you can extrapolate to say if your goal is to make $34,000, if you need $34,000 in income passively coming from dividends, then you know that you just need to build a dividend portfolio of $1 million. Then it pays you to $34,000 a year till you move on and your family will inherit the actual ETF portfolio, which has not dwindled. Because you have to understand the ETF, when they pay the dividend, it doesn't necessarily diminish your portfolio, right? And you don't have to sell your assets to get that income. That is why a lot of people like this option because it gives them the income option, especially people who are in the later quarter of their life after 60, moving into retirement by age and all of that. They can start having income coming from this. But for most people, generally, especially if you are much younger, it is better. That's my strategy. And you can leverage your own strategy. But my strategy and the strategy that works for a lot of people who follow and listen to me, when you're much younger, you're better off investing more in growth assets because the growth of those assets over time becomes very significant. So much so that even if you need to sell them and pay taxes on them and still get income, that income will be significantly more than the income that will be generated from dividends. So, for example, a $1 million portfolio in dividend ETFs will generate about $34,000 a year in dividends, right? But that same $1 million portfolio in growth assets, in growth ETFs like VOO, will generate you somewhere about 150, can even be $200,000 in growth a year. That's a significant difference, which means if you sell that growth, that amount, if you want If you sell that amount of assets, you pay taxes on those assets, you can still get more. But you also have to understand that to involve you selling, right? So what many people do and what is really important to think about, number one, is how much more time you still have till you want to retire or till you will need cash flow coming. Number two, right? Once you get to that time in your life, how much do you need in cash flow? That's what helps you now to be able to package and organize your portfolio. That is why I am organizing the seminar on the 26th, because I want to be able to help give people direction. A lot of people don't realize that it's not just enough to understand that, oh, I could buy an ETF. It's not enough to understand that I could buy a stock of a company or a share. It's more important to understand why you're buying it. What is your plan? What is your short, mid to long term plan? What is your goal? How soon do you need to leverage income? How much growth do you want out of that portfolio? Where do you want to position that portfolio? All these things matter. A lot of people fail not because they don't know about investing, but because they don't have the ingredients to be able to invest the right way, in a way that protects their money, keeps growth consistent, and a simplistic and repeatable fashion, so that they don't have to stress, they don't have to feel overwhelmed, and they don't have to feel discouraged, even when the market has a small downturn, which is temporary. That is why mentorship is so important. And I'm not saying that you must attend my seminar or you must come to me or you must follow me. No, whichever person you trust, but just make sure you have a mentor who can guide you in this process. To be where I am today, I've had a lot of mentors. Over the last 6 years, I've spent upwards of $80,000 to $90,000 just on training myself, just on developing my mind, understanding how these things work. Before coming on this live, you know what? Before coming on this live stream, I actually had scheduled, if you were paying attention, I had scheduled this live stream to start at 6 p.m. And then I realized, oh, I have to attend a training for AI. I know a lot about AI, but I need to continue to improve my skills. And that training in AI has given me tools which I'm going to bring to train you people, to give you people tools by which you can use to protect your job, to protect yourself, to protect your income, by which you can make yourself more marketable, make yourself in a position where you cannot be displaced. Even if you get displaced, you'll get other opportunities. How can you leverage AI to generate side income? How can you leverage AI to even make your portfolio better? And stay in touch. If you haven't subscribed to this channel, go ahead and subscribe, because these are the things I'll be teaching you going forward. Remember, as a wealth and legacy architect, my role is not only to just talk to you about finance. All right, finance is good. I can talk to you about ETF stocks and stuff like that, but I go a little bit further than that. Right? I'm not just a traditional finance guy. That's not my goal here. My goal is not to come to you every day and just talk to you about some money, invest in this. No, my goal is to also give you a bigger picture. Not only talk about the money, but give you tools to that you can use to leverage your skills and build. Right? So that way you have a lot more. And when you have a lot more, then you can invest a lot more. You have to understand that mindset. That's why you hear me not only talk about finance, but sometimes I'll talk to you about purpose. Because if you don't have a definite purpose, you don't have a clear vision, you don't have a clear plan while you are doing it, the most likely chance is that you're not going to be successful, because you are putting the cart ahead of the horse. You have to put the horse ahead of the cart. The horse is the purpose. Why am I doing this? Right? I talk to you about the legacy, because when you have a clear picture of the kind of legacy you want to leave and leave when you leave this world, your actions change. You start finding a way to focus on some of those things that matter, some of those things that are aligned with where you are going. Because if you don't have a plan, you don't have a picture of the destination, then you'll be wandering. I know that because I've wandered too a lot in my life. I wondered because I didn't take time to clarify what my purpose was, to clarify what my legacy that I want to bequeath is, to know exactly what it is. And once you understand that, then you start walking that path. It doesn't mean you have to have a complete picture. No. But once you have a complete, an understanding of what it is, you have a sense of the direction you want to go, start going in that direction. It doesn't mean you have to start sprinting. You can start walking slowly. And as you understand it, it becomes clearer, you start jogging. That is why I don't teach you only about basic finance. That's what, if it's just that, there are a lot of people who talk about finance on YouTube. That's a pound, a dollar a pound or something like that, right? But I want to go further than that. I want to take you to the places that will actually fortify you, to build a fortress around you, so that way you too can use the knowledge, the skill, and the experiences that you gain to also train your own children, to train your families, to train the generations that are coming after you, so that you leave things that they can learn from, right? So we're talking about the fourth ETF, the dividend growth ETF, right? So the key characteristics of this ETF, it focuses on profitable dividend paying companies. So you have companies like Pepsi, Coca-Cola, ExxonMobil, Walmart, Costco, Home Depot. These are companies that pay good dividends. Procter and Gamble, Colgate, Palmolive, they pay a lot of dividends because they are not growth companies. Their goal is not to grow too fast. Their goal is to just maintain the company, generate profit, and redistribute that to their company, to their shareholders. And if you notice, their growth is not too high compared to companies like technology companies that are focused more on growth, right? Because companies do three things with the profits they make. They can actually pay it out as a dividend, they can reinvest it back in the company, which means making the company bigger, building more, more offices, maybe buying more assets, buying other companies and things like that. You probably have heard recently that Netflix bought Warner Brothers, which is a movie production house, right? That is, Netflix is a growth company. So the money Netflix used to buy Warner Brothers, Netflix could have used that money to redistribute to its shareholders as dividend. Even though Netflix might give a dividend, but it's very small because a big chunk of their money, their profit, they're using it to reinvest in the business. But dividend companies usually just pay dividends. They don't reinvest much. They don't grow too fast. That's why you'll see the companies like Walmart, Costco, and all these other companies I've talked about, right? They also have a very low volatility, which means the stock is not as volatile generally, because the SCHD ETF contains these companies that are not too exposed. So they basically don't rise too fast and they don't fall too fast. So it's not too volatile. So they're generally more stable, right? And the income is the compounding engine, basically. So the compounding engine for SCHD and dividend growth ETFs of this category, SCHD, VIG, is not the price of the stock, but it's the dividend, which is the compounding power. In growth companies, it is a price. In 2022, Meta fell all the way down to $88. Today, Meta is $678. So think about it. Only 4 years ago, if you spent $88,000 to buy 1,000 shares of Meta at $88, today that same 88,000 you spent will be 768, 678,000. That's a significant amount of money, right? That's why when I talk about investing, it's no joke, guys. This thing is no child's play. This is the stuff that separates the winners from the losers. This is the stuff that separates those who are going to be happy in their later years and those who are going to be whining and complaining about their social security checks being delayed. I don't wish that for nobody, but I'm just talking about some of the realities that are out there, right? So let's keep going here. Now we are going to talk about the fifth ETF, and this one actually is a growth compounder, right? And if you're getting some value out of this, please drop me a comment. Let me know that you're on the line watching. Let me know where you're watching. If you have a question for me, please feel free to drop that question too. Now we are getting close to, we are landing the plane here slowly. So let's talk about the fifth ETF. The fifth ETF is the future capture. So this is an ETF that is actually the growth engine of your entire strategy, because this is the ETF that contains the growth companies in the ecosystem. This is the ETF that contains the tech companies, all those companies that register significant growth in the course of the year. The average growth of this ETF, and in this category, we have an ETF like QQQ, right? QQQ is an ETF that tracks the NASDAQ 100. And the NASDAQ 100 is the top 100 companies in America that is non-financial. And it tracks. And most of the companies in QQQ are technology companies. But QQQ also has a cheaper option, which is QQQM. Same ETF, same companies in it, just slightly cheaper. so that it is more affordable for people, right? QQQ is about, I think, 500 and something dollars, if I'm not mistaken. But the QQQM is about 200 and something dollars. But it's the same. You can buy either of them, you are still going to be in business, right? So if you've invested 60,000, for example, because QQQM grows 18 to 19% the last 10 years, averagely. That's a lot of growth. So if you had 500,000 invested and 60,000 over the last 10 years invested in it, your portfolio would have grown from 60 grand to about 175,000. That's 115,000 in growth. That's why I tell you the stock market is one of the real passive income streams you can ever think about, because you don't do nothing. All you did is just make an automatic investment strategy for $500 to be buying QQQM every month. That's it. You would have grown by about $115,000 today. That's not small money. Then imagine 20 years, imagine 30 years, right? Or imagine if instead of doing $500, you're doing $1,000. That is how you start thinking strategically. That's how now you shift from just becoming a basic investor, but now becoming a legacy wealth builder. That's why I want to get everybody who follows me to not only just think about the actions, but to think about the bigger picture of this thing, which is not complex. It eliminates overwhelm, but it also gives you a lot of peace and knowing that what you are expecting ahead will come to pass, right? The expense ratio for this is slightly higher. Of course, there's great returns, but the expense ratio is 0.20, which means it is $20 for every 10 for every 10,000, it is $20 a year. The other ones we've been talking about is somewhere about $3, $6, but this is $20, which means for 100,000, it is $200. But still, that's not big stuff, right? That's small stuff when you really think about the other things like the growth of the ETF. But here are the key characteristics of this ETF. It is tech heavy exposure. So if you want to invest in technology companies, but you don't certainly want to invest in one of them individually, this is one of those ETFs you can really look at acquiring. Because when you invest in QQQ or QQQM, you are basically investing in all these top technology companies, Tesla, Apple, name it, all of them, Micron, AMD, all of those technology companies, you are investing in them, right? Number two, AI, software, semiconductors. If you know anything about where AI is today, what AI involves, you know that AI requires a lot of chip companies to come into action. It requires high level chips that can process data fast and give results. That's where the NVIDIAs come into play. That's why you would have noticed that NVIDIA became one of the top two largest companies by market capitalization over the last 2, 3 years, because the demand for its chips became astronomical as AI is growing. So if you also want to invest in AI related companies, but you don't want to take a chance on an individual company, QQQM is a very, very good ETF that you should consider, right? And remember, again, this is not financial advice. This is just education. Take the information, do your own research, and make decisions. Remember, investment comes with risk. You can lose money. In fact, you will lose money. But if you just invest consistently over time, you will gain more money than you lose. There is nobody who invests and doesn't lose money. You need to understand that. You will lose money, but the key is I don't mind losing $100,000 and then end up gaining $1 million. That's how you have to think about it. Don't worry about the losses. You want to make sure that your losses are minimized. It is important. That's true. You want to minimize your losses. That's why I'm talking about ETFs, because ETFs minimize your losses because you don't take a risk on individual companies, right? So QQQM also has high volatility, as you expect, because the companies in QQQM are growth companies, and growth companies basically take a lot of risk. They invest a lot of money in acquiring other companies. They are trying to expand their market share. They are bringing innovative technologies. They spend a lot of money on research and development. So they generally grow fast, but they also have a lot of risk, because when there's a market downturn, they are the companies that get affected the most. So QQQM is a lot more volatile as an ETF than the other ones I talked about, right? But it has a higher historical upside. Like I told you, 18 to 19% growth over the last 10 years. You can go back and look from the inception of this ETF. You'll see the average growth rate. It's very good, it's very positive, and you can extrapolate based on that. You can even take just the average growth of the market at 10%, so that you see the worst case scenario. When I'm extrapolating calculations, when I'm doing I'm extrapolating calculations for my portfolio. I even go down to all the way to 9%. And the reason I do that is I say, okay, what's the worst case scenario? Even though I know my portfolios generally average upwards of 20 to 24% a year, but I just take the worst case scenario, right? Let me even just say everything goes wrong and it even goes that low. And then from there, you can project now and see. Then you realize there's just no way you can lose if you hold long enough. That is just the truth of the matter. There's just no way because the market has been there for 110 years. There's a history behind it. It's not going to be upended overnight. I understand all the things that is going on in the news. China is no longer is selling American treasury bills. Brazil is doing this. They are trying to make the dollar not become the new not to stay as the currency that is used for global trade. I understand all those things. Let me tell you something, guys. You cannot control most of those things. Those things are only going to give you anxiety. The only thing you can control is to continue to bet on the US economy and US companies and some other global companies you believe, you trust, and you're convinced about. All the other pieces of news you hear every day, they just give you anxiety. I don't listen to the news. A lot of the information I get is just maybe from, once in a while when I go on social media platforms like Instagram or something. When I go to YouTube, I watch specific video of the specific mentors I follow. And I do that intentionally because I don't want this information to continue to play in my head and then emotionally affect how I feel and then affect the decisions I make with my investments. Because investing is not, you have to safeguard yourself from yourself. You have to position safeguards that help you to protect your portfolio from yourself. Because people don't realize investing is emotional because we're emotional beings. So you must put in safeguards to make sure that at every point in time, your investment decisions are not guided by how you feel. It's guided by strategy. That's why a small number of people build so much wealth during economic downturns because a majority of people are not educated, are not they don't understand enough and cannot control their emotions. So when the market starts going down, they start selling their assets quick. And as they start selling their asset, it perpetuates that same trend. Remember, the stock market is a supply and demand thing. If 10 people want Tesla stocks and 20 people have Tesla stocks to sell, that means the supply is more than the demand. So the prices will go down. But if 10 people want Tesla stocks and only 2 people have those stocks to sell, naturally the prices will go up. So when more people start selling their shares, the prices go down because the supply becomes overwhelming and there's not enough people demanding for that. So the prices start going down. So the few people who are smart like you listening to me, what you do at that time is that you are getting those shares now at a discount because you know that at some point the market is going to reverse. And when it reverses, the value of those shares are going to start rising again. Because those same people, when the market reverses, they sold their shares for a loss, they will be coming back now to buy out of panic and fear of missing out because they'll be thinking they missed out something. So the same shares they sold for $80, they'll be coming back to buy for $100. And when they come back to buy, it makes a lot of demand for that share, and there are only so few people willing to sell. What happens? Prices are exploding. That's when now the shares you already own, the value now starts rising. This is how basic it is, guys. If you've done basic economics in secondary school, basic commerce, you understand this stuff. But the problem is when the tire hits the road, when you're watching the news and they keep pumping you this negativity, China is taking over, this is happening, Trump this one did this. What happens is that it slowly starts playing into your subconscious. And when it plays into your subconscious, you take an emotional decision. You always have to remember human beings are emotional beings. Human beings, most of the decisions they make are emotional decisions, and they try to use logic to justify it. I don't know if it makes sense. Just think about your own life. A lot of the things you buy are emotionally charged. But after buying them, then you start using logic. Well, I could spend that $300,000 for that shoe. I just need to do one additional shift. Oh well, I need to. I deserve it. I'm compensating myself. I've been good and all that stuff. You are just trying to use logic now to justify a foolish emotional decision you made. All these things you have to understand who you are as a human being. I am not immune to that, but now because I understand, I put safeguards around that. And some of the safeguards I put is that I have automated investment systems. I don't have to move the money manually. It invests by itself automatically, right? The safeguard I put in myself is that I pay myself first. Any kind of money that comes in, the investments go in first before anything else. The safeguards I put in place is that I don't check my account every day, because if you check it every day, you get anxious. You see it goes red, you get anxious. So some accounts, even I lose the password. For a lot of the people I coach, I tell them, lose your password. Just set up the automatic investment and lose the password. Don't go checking the account. Move on with your life. Move on with your life. Studies have indicated that on the Fidelity platform alone, most of the accounts that people lost their passwords ended up being some of the biggest accounts, because they can see from the back end the last time people checked their accounts, right? The accounts where people haven't checked in 10 years. And those accounts were compounding uninterrupted. So there is no emotional decision that forces the owner to maybe try to sell an asset, or to try to make some quick profit, or to try to trade something. So you have to understand how powerful this stuff is, right? So we were just talking here about the FIT ETF, which is the Innovation and Strategic Growth ETF, QQQ or QQQM. Now I want to recap on all of this, right? In the 5 ETFs we talked about today, and these are the 5 ETFs that you should consider owning for 20 years. And I mean it. No pun intended, guys. I mean it. Now you're talking about the foundational ETF, which is VT. VT is a total world ETF. It's a global ETF. It covers over 9,000 companies globally. You go from VT, you also consider VTI. VTI is covering companies in the US stock market. That's over 3,400 companies. After VTI, you want to invest in SCHD or a dividend income producing ETF. It could be SCHD or VIG. Any ETF that covers income or dividend, you can look. There are multiple other ones. The ones I name here is not a recommendation. It's just an example. There are other ETFs within that category sponsored by different companies, right? So for the dividend income category, you are looking at something like SCHD or VIG. Now you also have the innovation category, which is QQQ and QQQM. Then the fifth one, you are looking at the S&P 500 category, which is investing in the 500 largest companies by market capitalization in America, which is something like VOO or SPY. Now, guys, let's break this down, right? Let's learn very carefully. Now, I want you to understand, when I'm doing live stream like this, I do it in a workshop format. So I like interaction. And the reason I do it in a workshop format is so that you can take practical ideas and go implement. My goal is not just to come and give you information. That's not my goal. My goal as a wealth and legacy architect is to give you information and give you practical step-by-step ways by which you can implement that information. And of course, as you already know, if you need additional help, look down in the description of this video, click on the link. You can book a one-on-one private time with me. Let's have a conversation. Otherwise, on the 26th of February, I have the webinar coming up. But before then, I want you to understand this, right? Step one, you want to choose a structure. You want to choose a structure. What that means is you want to break down these 5 ETFs into what percentage of your portfolio each of them represents. So, for example, you could tell yourself, you know what? Okay, I have $1,000 to invest, to start investing. Of that $1,000, I'm going to put 35% of that amount to VTI, which is the US stock market ETF. I'm going to put 35%, which is $350 to VTI. Now you go to VT, which is the global ETF that covers over 9,000 companies globally. I am going to put 20% of that 1,000. That is $200. Now you go to VOO, which is the S&P 500 ETF that covers the 500 largest companies by market cap. I'm going to invest $200. And this is just an example, which is 20%. Now you come to the dividend income category of ETFs. SCHD or VIG, I'm going to invest 15%. And you don't only have to invest that total amount in one of the ETFs. You can decide if you like 2 of them, you break that amount into 2. So 7.5% to 1, 7.5% to 1. And then you know what? You come now to the growth ETF. You say you're going to invest maybe 10% to that. Now, what I just gave you is not any kind of recommendation. It also has to be determined by your goals, your age, where you're trying to go, how much time you have to invest or you plan to invest, and all of that information. That's why I tell you some of these things. If you get a little confusing and overwhelming and you need one on one help, always feel free to reach out, right? Let's work on it. I'll be able to help you build a very solid bulletproof portfolio that no matter what recession is coming through, you will be able to survive if you are just committed to invest for the long term. The first question I ask anybody who comes to me for coaching, the first question I ask them, how long do you want to invest? Because if you don't want to invest for the long term, I really cannot help you much. I don't have a crystal glass. All I can do is to put in strategies that if you follow those strategies and you hang in for a long term, 7 to 10 years, you are going to see significant results. Because you have to understand that the whole concept of compounding really accelerates with time. That's why the first couple of years you are putting in your money into an investment, it seems like nothing is happening. First year, nothing is happening. Second year, nothing is happening. Third year, because that foundational explosive concentration is being built. Then the fifth year, you start seeing some changes. By the 10th year, you see marvelous things happening. That is why, if I tell you right now that $250,000, right? It will take 13 years if you are investing $833 at an 8% growth rate. It will take 13 years for that money to grow to $250 to $250,000. But if you continue doing that same thing, investing the same $833, within the 13th year to the 26th year, that money will grow to $1 million. So the first 13 years, it grows to 250. The second 13 years, it grows by 750,000. What does that tell you? It tells you that compounding is an engine which is like the diesel engine. I remember when we were young, they will start a diesel engine and they'll let the engine run for a few minutes and warm up so that way it can get speedier. As you're driving a diesel car, you will notice that it gets faster as you get going with the journey. That's how compounding is. It doesn't start hot, it starts slow but steady. So when you're trying to break down your portfolio and decide how much percentage you want to invest in these different categories, you must have all of these thoughts in your mind, right? So the first step is to choose the structure. How much percentage do you want to invest in what category? The second thing, of course, you want to automate. Don't do manual investments, which every week or every month, depending on how often you want to invest, you go to the account and you go to Fidelity and you transfer money and you start buying the shares. Don't do that. Set it on automation. Automation generally helps people gain 35% more growth in their portfolios than people that do it manually, because the human being cannot be counted on. One of these times you'll be sick, the next time you'll be happy, you'll not be happy, you will forget, you'll be traveling, you'll get busy, you miss the timing. All these things happen. But you want to avoid all of that by automating. Those are all the things we can help you within in my community, right? The third thing, you want to reinvest your dividends. So there will always be a button when you buy a share which pays dividend. There will always be a button that you need to click to instruct the platform to reinvest your dividends. If you don't click that check mark, they'll be paying you the dividends into the account that is registered on that platform. So let's say you're on Fidelity, and by all means, I'm not selling Fidelity here or anything. You could use any Fidelity, Schwab, Vanguard, what's the name, Robinhood, any of them that you like, right? Interactive brokers. None of them is paying me a commission. I'm just giving you options here. If you look at that platform, when you are setting up your account, you have to set up a bank account which is going to furnish funds into the investment platform. So if you don't choose reinvest dividends, they'll take that money and bring it back as cash into that bank account, right? The fourth thing you want to do, you want to rebalance annually. That's one of the biggest key strategies a lot of people don't realize. So it's just not enough to invest in these portfolios. It's not just enough to invest in these ETFs and companies, but you also have to rebalance them. You also have to see maybe you need to invest instead of 20% for the growth companies. The next 10 years is going to be a growth era. So you maybe want to invest a little bit more into growth, and you have to rebalance those things, right? That is where expertise comes into play. Now, the fifth and most important thing, you don't want to interrupt compounding. You don't want to be selling your shares. You don't want to go to your portfolio and during hard times, you go sell your shares. That is why it is important to have an emergency fund first. So that way, if something happens, you are not obliged to go sell your shares. Because every time you break the compounding momentum, it's hard to catch up. It's hard to catch up. That is why, let me tell you something. That is why somebody who is 18 years old, if they invest $500,000 a month from the age of 18 and they stop 10 years after at the age of 28, they don't invest nothing else. And somebody starts from the age of 28 till the age of 65, both of them are going to the age of 65. And the person who starts at the age of 28, investing $1,500 a month, at the age of 65, the person who invested in the first 10 years from 18 to 28 will still end up with more money because they'll have compounding that has not been broken. This person missed 10 years. Now, if you're sitting and listening to me, you're in your 30s, you're in your 40s, it's not late. You haven't missed anything. You have missed some years, but listen, it's not misses because you didn't know. Now you know. That is why it is important for you to do the things that it takes to get involved with investing in the market. That is why I'll be teaching you about how AI can help you make additional income, how AI can help you do all of these different things, right? So that's why you need to connect to this channel. Go ahead and click the subscription key, click the thumbs up. That way you will get information as we get going. The fifth and most important thing, as I said, do not interrupt compounding. Let compounding work. Let compounding run. Don't stop it. Guys, I hope you've been having value from what I've been sharing today. I pray that it's been making sense to you, right? Because you need to understand something here. What I shared to you in this live stream, what I share in the other videos, you are not just building a portfolio. You are constructing a legacy ownership structure. You are not only an investor, but you are a legacy burden carrier. You are carrying the burden for your family. You are carrying the burden for generations to come. You are setting up a platform, an infrastructure, and a legacy asset that you will live on and you hand it over. So this is not just about income. This is about economic insulation. This is about intergenerational leverage. Because when you build a portfolio like what I've talked about in this live stream, it's not just about the income you're going to make for it. It's that you're building something that can intergenerationally go forward, that generations can leverage. Because imagine that $60,000 invested over 10 years grows to $175,000 if you're talking about something like QQQM or QQQ. And that's just 10 years. Imagine 20 years, what that will be. Now imagine instead of $500 a month, which brought up, which cumulatively made 60,000 in 10 years. Imagine it was $1,000 a month. Sorry. So that means 120,000 in 10 years. Imagine what that would have done to your portfolio. Now imagine if you're disciplined enough to stay the course and just keep doing that. Of course, even when the crashes come, you keep moving. Even when the downturns come, you buy more if you have extra money and you keep moving. But with your disciplined ownership over time, not minding about volatility, making sure you stay invested in ETFs that mitigate your risk like the ones I've talked about. So that when the markets fall, you don't even worry about it. But when they turn around, you are part of the rising storm and the momentum picks you up. Just imagine how that will be like. But even during those times when things look red, when you feel discouraged, when even the newscasters are preaching doom and death and death to the economy, let me remind you, just remember BBB. Buy, baby, buy. Just keep investing in yourself, keep investing in your future, all right? And of course, if you want help building this kind of portfolio or you want help building income, your goals, and your life, and this legacy structure, right? I'll be doing a webinar on the 26th of February for those who might have joined the live stream later. And this is coming up on the 26th of February from 6 p.m. to 8:30 p.m. Central Standard Time. This is a 90 minutes first session, which is the general session. That is $97 only as an investment. For 90 minutes, I'll be teaching you on how to organize your money, how to build investment portfolios, what kind of investments to invest, and how to stay the course. I'll be giving you a clear plan. I'll be giving you step-by-step guide which you can take home with you. I'll be giving you worksheets. I'll be giving you calculators to project your future value of your investment, right? And you're going to be able to live with confidence. You're going to be able to invest without overwhelm, without confusion. You're going to be able to have clarity on how to proceed and build wealth. If you've already started doing that, this seminar is going to help you to accelerate that process. If you haven't started, it's going to help you to give you a leg up to get going with that, right? But now, if clarity and speed matters to you, if you want to break the speed barrier faster and you want to go faster and win faster, then you have to buy the VIP ticket, which is $197 only in investment. Because that doesn't only give you access to the General Assembly call for 1 hour, 30 minutes, but you have an additional 1 hour with me, one-on-one, mano a mano, where I will answer all the questions you have. So you are guaranteed to ask a question and you will be guaranteed to have a response to that question. That's a privilege you don't have in the general gathering, right? Just because, in addition, you have discounted rates on our future events and our future trainings that are coming up. I am working on the background. I have a team of 7 guys. I don't do this alone. I have a whole company. I have a whole team. And we are building programs, we are building trainings, we are building virtual trainings, we are building all these different tools to help you become successful in the craft of not only investing, but building your legacy, in the craft of chasing your dreams and be able to see clearly and build something that you can bequeath to future generations. So if you are a winner, if you are one of those people who want to be part of the distinguishing class, who don't want to waste too much time learning and failing first, who want to cut their pain propensity by 50%, who need direct access to some of those key strategies that can change the investment landscape for you, then you have to be part of this VIP group. And the tickets are going very fast. Look in the description of this video. If you're on Facebook, I'm going to attach the link. No, look in the comment section on Facebook. If you're on Facebook, you click on the link, you secure your ticket. Same for Instagram. For YouTube, it's in the description of this video. Let's get going with this, right? I wish you well. I wish you luck. And I wish you great achievements in your life. Because I want to leave you with something. You know, I might not know you personally. I might never really have a chance to meet you physically. I don't know where you were born. I don't know where you were raised. I don't know the circumstances under which you were raised. But I know one thing, that things might have been spoken upon your life. Circumstances might have forced you to believe that you're not smart, you're not intelligent, that you don't have what it takes, you don't have the courage, you don't have the mind, you don't have the gift. I want to remind you that all those things which were spoken, all those circumstances that might have made you to believe in those lies, it's not true. Because what is most important is that things will happen around you. Things will happen with you. Things will happen in front and behind you. But the most important things are the things that happen in you. I want to remind you that you're smart enough, that you're intelligent enough, that you're courageous, that you are capable of changing the direction of your life if it is not going in the direction you've always aspired for. That you have everything it takes in you to win, not only in this life, but to also win in leaving a legacy for the family that is coming after you. So as you go out today, be well, be blessed, and by all means, never forget being a blessing to somebody. And until the next time, I will see you in the next live stream tomorrow. Bye for now.